Many people mistakenly ask about buying shares in an LLC, but the truth is that limited liability companies don't issue shares at all. This fundamental difference from corporations creates confusion for entrepreneurs and investors alike. Today we're clearing up what LLC ownership really means and how it works. Unlike corporations, LLCs don't have shareholders or stock certificates. Instead, they have members who own membership interests or units. This distinction isn't just semantic, it reflects a completely different approach to business ownership and structure. When you own part of an LLC, your ownership is typically expressed as a percentage. For example, you might own 25% of an LLC, or you might own 50 membership units out of 100 total units. These percentages or units determine your claim to business assets and your portion of profits. LLC ownership is formalized through an operating agreement, rather than stock certificates. This agreement outlines each member's rights, responsibilities, and ownership stake. It serves as the governing document for the business relationship between members. While LLCs cannot issue stock, they can offer ownership to investors in several ways. Investors can receive a percentage of ownership or membership units based on their capital contributions. Some LLCs offer profits interests or sweat equity in exchange for services, rather than financial investment. Membership interests in LLCs typically come in two forms. Economic interests give you the right to receive distributions of profits and losses. Management interests provide the right to participate in business decisions and vote on company matters. These rights can be divided among members in various ways and don't necessarily have to match their investment proportions. Some LLCs issue membership certificates as symbolic proof of ownership. However, these are not the same as stock certificates and don't represent tradable shares. They simply serve as a record of membership for internal purposes. The tax structure of an LLC also differs significantly from corporations. LLCs are typically taxed as pass-through entities, meaning profits flow directly to the members' personal tax returns. This avoids the double taxation that occurs with C corporations, where profits are taxed at both the corporate and individual levels. One major advantage of LLCs is their flexibility in creating customized ownership arrangements. You can establish multiple classes of members with different voting rights or profit shares. Some members can receive preferred distributions, getting paid before others. You can even create special allocations that assign profits or losses in ways that don't match ownership percentages. LLCs can elect to be taxed as corporations by filing the appropriate IRS forms, but this only changes their tax treatment. Even with this election, an LLC still cannot issue shares, and ownership remains in the form of membership interests rather than stock. For those seeking investors, it's important to understand that while LLCs cannot offer stock options like corporations, they can create similar incentives through carefully structured operating agreements. These might include performance-based ownership increases or special profit allocations. To summarize, LLCs do not and cannot issue shares. Ownership is based on membership interests or units. Only corporations can issue stock. LLC membership interests can be customized to include rights similar to corporate stock. LLCs offer remarkable flexibility in profit sharing, ownership classes, and management structures. And while LLCs may choose to be taxed as corporations, this doesn't allow them to issue stock. Understanding these distinctions is crucial for entrepreneurs deciding on a business structure and for investors considering where to put their capital.